Hello everybody, this video is entitled Max 7 Stocks, 2 are cheap. In my view, there are 2 clear winners as far as Max 7s go for the valuation. And this is of course where I use my usual spreadsheet where I judge a stock based on really 2 factors. It's enterprise value over gross profit over revenue growth. Why do I use gross profit and not EBITDA margin in that metric? Because I tend to consider that a lot of the expenses after gross profit tend to be investment and not necessarily a cost. I look at them as an investment, right? For example, a company that say would spend a lot of money in marketing or a lot of money in CapEx for their data centers, depreciation, all that sort of stuff that happens after the gross profit line. I consider this an investment. Traditional accounting, traditional finance considers this a cost. So that's the idea behind using gross profit instead of using earnings. And this is a spin on the PEG ratio of Peter Lynch, of course. And Peter Lynch used price. I also consider price to not be as good as enterprise value. The main reason why Peter Lynch used to use price in his formula is because price was much easier to get back then, but today it's easier to get enterprise value. Enterprise value, of course, corrects for debt and for dislocation of valuation due to debt. And then I use revenue growth. I use revenue growth in there simply as a proxy for gross profit growth, but gross profit growth is not really visible anywhere. Right? So revenue growth is what I use. And if a company is optimized for gross profit, which all these companies are optimized for gross profit, then revenue growth should loosely match gross profit growth, roughly. And so the goal, of course, is the cost of growth. How much am I paying for that growth? Is it expensive? Is the next 12 months growth expensive? And I want to pay as little as possible for that growth. And so Peter Lynch used to consider stocks to be a buy in his ratio if stocks were trading under 1. Me, in my ratio, I consider stocks to be a buy when they are under a 0.5. And there are 2 stocks that are under a 0.5. They're close to a 0.5, but they're under a 0.5. These are NVDA and Meta. And even though it may seem expensive compared to other stocks I cover on the channel, like, I don't know, HIMS, for example, it's actually dirt cheap when you consider that these stocks are literally the most marginable, the most respected stocks in the world. NVIDIA and Meta are part of this very exclusive group of Max 7 stocks. And so and of course, rule of 40. Rule of 40 is revenue growth plus EBITDA margin. VCs tend to like rule of 40 above a 40. Right, so when you add up growth and EBITDA, you gotta get above a 40, and you can see that some of the stocks I'm gonna cover are well above a 40, so more than buyable for VCs. Okay, so we get started with Apple. I don't have much to say about Apple except that they are the privacy king, and of course it sees a lot of demand right now from AI, from people who want to run locally some of these models, especially on Mac Minis. Also, Apple had some success with their latest iPhone. I think that success surprised them themselves. So that's why the forward revenue growth for Apple is actually 10% next 12 months. I consider Apple to be super expensive at a 2 over EV over GP or over RG is a 2. I consider that too expensive. Of course, Tesla looks even more expensive, but Tesla is a special situation. I'll get to Tesla towards the end of the video. Moving on and comparing, of course, Apple, comparing it to NVIDIA. NVIDIA in my spreadsheet is more than 4 times cheaper than Apple. More than 4 times cheaper than Apple. And that's because we are predicted to have 61% revenue growth. I believe that number from analysts, I use that number from analysts, I believe that's way too low. I think NVIDIA will do much more, right? They did say $500 billion over 5 months, so I think they'll do much more. My revenue number trailing 12 months is only showing 250 billion. So if they do actually $500 billion, that should be closer to 100. So I may be actually sandbagging the 61% revenue growth for NVIDIA here. NVIDIA looking just too cheap. Look at the products announcements that they had on Monday, going for a PC market. Lots of excitement regarding the roadmap of NVIDIA. NVIDIA remains the AI king. NVIDIA has a huge VC arm where they invested in so many companies. They were sprinkling 2 billion here, 2 billion there, 2 billion there. And people were making fun of them a few months ago saying, oh, that's circular revenue, but NVIDIA looking really smart right now, as most of these stocks that they sprinkle 2 billion on are like 3x or 2x what they used to be, right? The prime example is Nebius. They invested 2 billion in Nebius. Nebius is up something like 150% since they invested. So I guess NVIDIA turned 2 billion into 5 billion in next to no time because of that quote-unquote circular revenue that CNBC disliked so much. I don't understand why NVIDIA is so cheap. I think NVIDIA is much cheaper than, for example, an AMD or even a Micron. I think they've shown longevity in their competitive advantage. AI is the GPU revolution. It is still the GPU revolution. The GPU is still the most important part. I know the market's getting excited about all sorts of bottlenecks, but to me, NVIDIA, especially when it is one of the cheapest in my spreadsheet, to me, NVIDIA I find quite interesting. Amazon. Let's talk briefly about Amazon. Amazon is cheap, trading at a 0.56, not quite under 0.5, but Amazon is cheap. The problem with Amazon, of course, is that they keep reinvesting a lot of money in their cloud business, in AWS. The market got spooked a little bit by that also. Amazon cannot grow the top line as fast as the other players because, look, they have $750 billion in revenue for Amazon. So it's a little tougher for them to grow the top line. And they invest a lot in AI right now, which is spooking a little bit the market. And because of that, you don't get the rule of 40. We're at a 34 on the rule of 40 because of that. I still consider Amazon too cheap. I think there's been a news recently on Amazon that's flying under the radar, and that news, of course, is them opening up their shipping network and competing against FedEx and UPS with their shipping networks. I think that's going to be a big deal. But Amazon, the Amazon thesis may take longer to realize than a year, much longer to realize than a year. That's why it's not showing here in my spreadsheet. Then, talking about Google. Google had a pretty successful capital raise. Aren't we at 85 billion or something like that? Google is selling stock. That is very smart to sell stock when your stock has doubled in the past 52 weeks. In the past 52 weeks, Google doubled. So I think it's very wise that they're raising capital. And because of that capital raise, you can see Google was trading at 400 not too long ago. It's now trading at 350. I think it's much more reasonable. Google was one of these Max 7 who had really gotten ahead of itself. And I like to see it down a little bit, but I still find it too expensive at a 0.94. It's actually the second most expensive Max 7 if I remove the special situation of Tesla, which I'll get to in a second. One more thing I wanted, just let me circle back really quickly to NVIDIA. One more thing I wanted to mention about NVIDIA is if you look at the chart of NVIDIA, and I'm not a chartist, obviously, but if you look at the chart of NVIDIA, you can see this stock was $180, I guess 10 months ago. So going from 180 to 216 in 10 months is not that far-fetched. In other words, the revenue growth at NVIDIA is greatly outpacing. It's greatly outpacing the stock growth. The stock has not grown as fast as revenue growth. This is not something you can say about a lot of stocks out there. Many stocks, have doubled, tripled. In the case of Micron, 10x when the revenue is not really 10xing right away. So it's important. I like to see my stocks track revenue growth. NVIDIA has under-tracked it. And so I find NVIDIA, again, at least for the past 10 months, it's not showing in the 52 weeks, but in the 10 months, it would show that we've under-tracked it. Okay, moving on to objectively the most attractive Max 7. In my view, the most attractive Max 7 is Meta, and I guess you would have to debate between Meta and NVIDIA. NVIDIA has a rule of 40 that is much higher than Meta because NVIDIA is growing much faster than Meta, and so I would argue all things in balance, it's probably worth paying a tad more to get a rule of 40 of 126. Probably NVIDIA still wins, but Meta is a secondary winner. And when you look at the fact that the performance of Meta over the past 52 weeks has been negative 5%, if you look at the stock, it's gone nowhere. And I am sure that chartists looking at this chart would be like, well, what's going on? everything is going up, Meta is not going up, and we don't understand that because, of course, Meta is also at the heart of AI. Meta has enormous data centers. It uses AI for its own benefit via better targeting of the ads, via more addictive apps. But they just launched Instagram Plus, WhatsApp Plus, Facebook Plus. They just launched a subscription business, and they just launched today their own AI agent who can quote unquote do stuff for you and run a lot of these social media businesses, maybe run by your Meta agent in the future. And I think this is going to be a big deal, and they're going to be able to upsell their Instagram Plus just for the fact that people want to use the Meta AI agent. Don't forget that Meta's AI has fallen a little bit behind, and we'll see how good Spark does. But Meta used to be one of the better AIs out there a year and a half ago. Like a year and a half ago, Llama 3 was top of the line. So they've fallen a little behind, but I definitely wouldn't count them out. And if you're growing very fast, 22% top line revenue growth is actually really good for a company of this size. Gross margin is outstanding at 82%. EBITDA margin is 51%. I mean, these are dream cash machine-like businesses, right? Oh, Meta, don't forget, of course, has the glasses business, the AR, VR business, but especially the Ray-Ban Meta glasses are also extremely successful on social media, and it's definitely not a loss for Meta. So I wouldn't count them out. I think they have a lot to run. They have a lot to go. Talking about Microsoft, Microsoft still looks expensive in my spreadsheet at a 0.93. Microsoft, unfortunately, looks expensive right here. There's the issues with Microsoft. One of them is, of course, they're investing a lot of money in AI, and they have a lot of exposure to OpenAI. So we'll have to see how well the OpenAI IPO actually does for Microsoft. Could be an overhang on the stock. Microsoft also suffers from having been coupled with the software trade, or the anti-software trade. But even though the chart of Microsoft is quite down actually compared to where it used to be just a year ago, it's actually on my spreadsheet still looking a little expensive. Microsoft is still looking a little expensive. And the one thing that I like about Microsoft, which I'll just say right now, is their quantum initiatives. They have a lot of exposure to quantum computing. They've been doing it for 20 years. I think this could be a catalyst for the stock at one point, quantum exposure. Of course, Google too. Google has a lot of quantum computing exposure too. So over the very long run, in my view, these Max 7s tend to be a no-brainer over a very long run. Microsoft, I would like to see a little cheaper, especially when NVIDIA can be added at 0.46 with a rule of 40. That is nearly twice as high as Microsoft. And lastly, I will conclude with Tesla. Tesla is a special situation. Tesla is a special situation because you have the founder premium. You have the Elon Musk premium on Tesla. Elon Musk's companies are always very expensive. Elon Musk is widely regarded as the greatest entrepreneur of our time, and therefore there is a premium. There is also another problem with Tesla, which is the next 12-month revenue growth is only showing at 7%. Why? Because a lot of the super high revenue, super high growth initiatives of Tesla are really kicking in the late 2020s. Like it's really 2028, 2029, 2030. That's when we see enormous revenue kicking in for Tesla. So in many ways, one could argue Tesla is a little early, and they keep postponing. The deadlines is the issue with Tesla. Is like you can never really know when they actually achieve their deadline or when they need to postpone it. Right? Robotaxi is launching, and it is a success where it's launching, but it's launching painfully slow, right? Painfully slow, and so nobody really knows when that ramps. When that ramps is when Wall Street starts to notice, and when Wall Street starts to notice, that's when the stock price goes up. That's when the revenue eventually goes up. But Tesla's revenue, and this is a little bit like Amazon, right? Amazon's revenue is very, very often years and years away, and it can't be captured in next 12 months growth, right? Tesla is the same issue. Their revenue is years and years away. It can't really be captured in the next 12 months growth. That's not the case for Apple. That's not the case for NVIDIA. NVIDIA's prime time revenue right now. Meta's prime time revenue right now. So for all of these stocks, actually, except perhaps Amazon, but all of these stocks actually will see a lot of their growth in the next 12 months. For Tesla, that's definitely not the case. For Amazon, it's a little bit less of the case, right? Amazon has very long-range investments. So that's kind of a differentiation. But let me conclude this video. Two winners in my view, Meta and NVIDIA. These are the two winners. There's a little, if you were to pick, there's a little psychology that goes into it. Like, do you want to buy a stock that's up 61% in 52 weeks, or do you want to buy a stock that's been down 5% and left behind for 52 weeks? Meta has a history of periodically getting left behind and then popping. And so we'll see if that actually happens this time for Meta. But I like these two. I like these two right now. And when NVIDIA looks so compelling, I have a hard time justifying looking at a stock like Micron or AMD when NVIDIA seems so compelling, at least from a valuation standpoint. So anyways, this is not investment advice. This is not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon, follow me on X. Thank you for watching and have a wonderful, wonderful day.